Welcome back to the Day Trading for Beginners podcast. So this is episode 5. And in this episode, we're going to start to take action and we're going to begin our education on this whole process of learning how to become a day trader. So what we're going to do in this episode is review some basics about the stock market and stocks in general. So this is a beginner's guide to understanding what stocks are and how they work. So depending on where you are in your journey towards becoming a day trader, you might find this really basic, or you might want to get a refresh on this stuff like I sort of needed to do. So what we're going to do here is we're going to review what stocks are, how the stock market works, and then sort of summarize all the key findings and the key points regarding this. So again, as someone who is pursuing a career as a day trader, I sort of feel like I need to start from scratch and just review some basics. I know this stuff pretty well, but I want to fill in a few gaps, and I just want to make sure I have a good base of foundational information. So this is sort of like my stock market review podcast. So I want to keep it short, to the point. And then in the show notes, I will include any links that pertain to the information that we're covering here. Okay. So let's start. What are stocks? A stock, it's also known as a share or equity. And basically it represents ownership in a company. So when you buy a stock, you're buying a piece of the company's profits and assets. And here's a really quick example that sort of helps me understand that, because when you say, you own a stock, you own a share, or you own a piece of that company, for me, that's really kind of vague. And I don't have a crystal clear understanding when that is told to me. It just sort of seems foreign. So with an example, we'll better understand sort of how that works. So personally, I own Tesla stock, and I follow some, good people for education reasons in the Tesla community. And there's one person called Jason DeBolt. He's a popular Tesla shareholder, and he did some calculations based on the amount of shares that are outstanding for Tesla. And he came up with a sort of rough estimation that 100 shares equals 1 second of production. So if you owned, let's say, 6,000 shares of Tesla, this represents 1 minute of production per year. So now imagine, everything that goes on in the entire Tesla company across, its factories all over the world. And every year you own 1 minute of all that production. So you can, January 1st or any day of the week, you can start your stopwatch. You can count 60 seconds, and everything that is happening in Tesla, if you own 6,000 shares, that's what you own. That you own those assets, and you own all the production that is going on. That's sort of like the share ownership that you have. Now, 6,000 shares is quite a lot, but that's just for demonstration purposes to equal 1 minute. So whatever type of shares you might own, you can sort of do that calculation and kind of reduce the production time you own. But that example sort of paints a better picture of what you own. So I own about 1 minute of production every year on Tesla. Now, you might think, that's small, but if you extrapolate out into 2030, what Tesla potentially might do, you can see that my ownership is going to grow and grow every single year. So I think that's a pretty cool way to think about, stock ownership. And, stock ownership, when you own a stock, it comes with certain rights as well. So there's some voting rights that you might have at shareholder meetings. You might potentially be able to receive dividends if a company awards dividends, and so on. So that sort of is what a stock is. It's a share. It's a bit of ownership of the company. So, how does this all work? Well, we kind of need to review why stocks exist in the first place. So back in sort of like the 16th or 17th century, the first stock was issued to the public, and the first company sort of issued stock to the public. So why did they do this? Well, by issuing stocks, a company gets money in return, and they can use this money to fund their growth and operation. So if a company wants to expand, wants to grow, they can issue shares in their company for money in return. And then people own a share of the company and they can use that fund to grow their business. So today, it all starts with something called an IPO. It's an initial public offering. And this is the process of a private company going public. And this is when they offer shares to the public for the very first time. So every company that is on the stock market has, gone through this IPO process. And there are, many reasons why a company sort of quote unquote goes public. But the main reason is to raise money. And that's sort of the way that I'm going to think about it. So when a company gets listed on the stock market for the first time, people can buy shares and the company receives the money, and then they can use this money again to grow and expand their business. So, how does, this all work? How does the stock market actually work? Well, let's talk about Tesla again for this sort of illustration. Tesla's stock price is around $250. So we are talking now, we're sort of early January. So if you invested $1,000 in Tesla at their IPO many years ago, you would have $220,000 right now. So the stock market is where shares of public companies such as Tesla and many other public companies can be bought and sold. So people like you and me, we are called retail investors, and we can buy and sell stock along with institutional investors. So these are companies and organizations that buy stock for their clients. So remember, stocks are investments. The stock market, it's where you buy and sell these investments through various stock exchanges. So when you buy and sell stock, you're buying and selling from other investors, not the actual company. So the initial public offering, the company sells the shares. But now if you buy and sell stock, you are doing that from other investors like yourself or like institutions that want to either buy or sell. So during Tesla's IPO, its shares were listed on the NASDAQ. So the NASDAQ is a stock exchange where many tech companies list their shares. So there are various types of exchanges within, this whole stock market. And the NASDAQ is a exchange where tech companies are, and then there are various other types of exchanges. So you can think of stock exchanges as sort of a marketplace where stocks are bought and sold. And again, there are several stock exchanges all over the world. So there's the New York Stock Exchange, there's the NASDAQ, so those two are in the USA, and there's the Shanghai Stock Exchange, so that's in China, and obviously that would have Chinese companies, and so on. Then there's a Toronto Stock Exchange in Canada, and so on. Now, there are also market indexes. So these are a little different than the stock exchanges. And the market indexes, basically, they're statistical measures that track the performance of a specific group of stocks. So the main popular one is the Standard & Poor's 500 index. So the S&P 500, which is very, very popular. And basically that includes the 500 biggest companies that are listed on the stock exchanges in the United States. So the S&P 500, it's a market index that lists the 500 biggest companies in the United States. And it's a measurement of how well those companies are doing. The NASDAQ Composite Index includes all the stocks listed on the NASDAQ Stock Exchange. So that's like the tech companies, the internet companies, and so on. So these indexes can help you track the performance of various markets and segments. And there are a bunch of main indexes. There's the Dow Jones Industrial Average, the S&P 500, the NASDAQ, and so on. And then there's various indexes for other locations around the world. Now, in order for you to buy and sell shares of a company, you will trade through a brokerage firm, which acts as an intermediary in the stock market. So there are many different brokerage firms that you can use. These days, you can basically just sign up for an online brokerage firm and you can do everything from your computer. So you use a brokerage firm and they help do the buying and selling of shares that you want on one of these exchanges. So it's all sort of done through them. There are many big popular ones that we've probably heard of in the United States: Charles Schwab, Fidelity Investments, TD Ameritrade, E-Trade, and then Robinhood. That's, the first sort of mobile brokerage firm that's very popular for retail investors. And then if you're in Canada, like me, you've got, your banks that are going to do some of the brokerage firm tasks for you. So TD Investing, RBC Investing. I personally have an account with Questrade, and then I'm going to open up an account with Interactive Brokers to do my day trading. But Questrade, it's super simple. I just signed up for an account online. I sent them a few documents. I e-transferred money from my personal banking account to my Questrade account. And now I deposited money and I can buy and sell stock in Questrade. So Questrade is the brokerage firm that's going to use my money and help me sort of execute trades among the various exchanges. So this is the brokerage firm that I use. And again, there are many that you can use. You can sign up and you can use them just online. So the days of, buying stock, it used to be much more difficult. And now it's just very, very easy. You can, sign up for an online brokerage account, and you basically e-transfer your money over to them. You have your account funded and you can buy and sell stock. So it's very, very easy to do. Now, what about, stock prices and how do they maybe work and how do they fluctuate a bit? So this is sort of like the last part of this podcast, and we'll wrap it up after this. But, if we want to talk about this, let's just continue with this Tesla example that we've kind of been using throughout this discussion. So here's sort of like a textbook boring definition of why a price of a stock might move. So the price of a stock is primarily determined by supply and demand dynamics in the marketplace. So what this means is that if more people want to buy a stock than sell it, then the price goes up. And if more people want to sell than buy, then the price goes down. So this pricing, it's also influenced by, investors' perception of the company, of its future prospect, of the financial performance that's happening, or maybe like broader economic conditions. So stock prices, they're set through the auction process on the various exchanges, and where there is a balance between buyers' bids and sellers' asks, this determines the final price. So let's kind of take that boring kind of textbook definition and kind of just discuss this Tesla example so we can see how a price of a stock will rise over time when conditions are good and the company's performing well. So when Tesla first went public, its stock price was significantly lower than it is today. As I mentioned earlier, at the time of producing this podcast, Tesla's stock price stands around, let's say, $250. Now, this remarkable increase in stock price over the years, it can be attributed to several factors. So as Tesla grew, developed new technologies, expanded its product capabilities, and reported increasing sales and profits, more investors wanted to buy its stock. Seeing that the company was as valuable as it has been and having strong future prospects, more and more people want to own some of Tesla. And this increase in demand, coupled with a relatively fixed supply of shares, so Tesla didn't issue more shares over the years, drove the stock price up. Now, Tesla's innovative approach in the EV market and its influence on, other automotive players also played a critical role in, its stock going up and people kind of seeing what's going on in the broader, automotive market, meaning that, EVs are here and they're kind of growing every year. So as the company, achieved these various milestones, garnered positive attention, investors' confidence grew, this fueled more demand for Tesla shares and the price goes up. So the stock market, where shares of companies like Tesla are traded, it operates on these principles of supply and demand. So as Tesla became more valuable as a company, the demand for its shares increased, leading to its stock going up. And this is sort of a clear example of how a company's growth and success can directly influence its stock price. in the market over the long term. So this is, over, the last several years of Tesla executing well, day to day, week to week, prices fluctuate and anything could sort of make prices go up and down. But if you kind of span out and you have a longer time frame, like a 5-year overview, or a 5-year investing kind of timeline, you can kind of see how this all plays out. And eventually the stock price catches up to where the company should be. So again, investing $1,000 in Tesla when it first IPO'd, considering the stock's substantial growth over the years, now you'd have something like over $220,000 today. And then think, what do you think that price will be in 2030 as Tesla is going on the trajectory that it is going? So obviously, I am a Tesla fan. I'm a big Tesla investor. So this exemplifies the potential for significant returns in the stock market, especially when investing in companies that show promising growth and innovation. But don't forget, stocks don't always go up. Just like they go up, they can come crashing down along with your profits if the company is not doing well. So I think that's a good sort of introduction to what a stock is, how the stock market works. And that's sort of a good refresh for me personally. So here I'm going to just go over some key insights that we spoke about in this podcast. So firstly, stocks, they represent ownership. So owning a stock means you're holding a piece of a company's profits and assets. And the example we talked about, Tesla stock, equates to owning a fraction of the company's production capacity. Historical context of stocks, this concept of issuing stocks started in the 17th century, around that time, as a means for companies to raise funds for expansion. The IPO process, so the initial public offering process, this marks the transition from a private company to a public one, allowing it to raise capital by offering shares to the public. Stock market dynamics. So the stock market, it's a platform where shares of companies, such as Tesla in this example, but all the companies that are on the stock market are traded back and forth. It includes retail investors like you and me, but also institutional investors. And it's facilitated by the various stock exchanges worldwide. So we talked about the New York Stock Exchange, the NASDAQ, and there are many other exchanges all over the world. These exchanges, they serve as the marketplaces for buying and selling stocks. And the brokerage firms are sort of like the intermediaries. So brokerage firms, online and traditional, they act as the intermediaries for investors to buy and sell stocks. So we talked about market indexes as well. There's big indexes like the S&P 500 and the NASDAQ, and they track the performance of a group of stocks, providing insights into various trends. And then we talked about, stock price determination. So the price of stocks, it's determined by supply and demand, as well as factors like company performance and investor perception. Potential for high returns. Investments in stocks, they do have the potential for significant returns, but there's always a risk. While stocks can offer high returns, they can also decrease in value, highlighting the importance for understanding all the market risks. So I think that's a good sort of refresh of what stocks are, where they're traded, the various exchanges, the stock market in general. And I think it's good for us as beginners pursuing a career as a day trader to get a good understanding of this. So in the future podcasts, we're going to do more of this. We're going to maybe look at bonds. We're going to talk about commodities, futures, and then we're going to get into more of the specifics of actual day trading as well, with some sort of educational podcasts like this, doing sort of a good review of some market fundamentals. So I hope that you found this useful. Subscribe to the podcast below in the show notes. If you get access to them, I'm going to link any resources I used, and also link where you can follow other social media channels for this day trading for beginners journey that we are going on. So thanks so much for listening. Subscribe to the podcast, and I will talk to you in the next one.